Hello. Today's lecture we will take a look at supply-side policies that would impact the macroeconomy. The overall goal of this lecture is to evaluate the role of supply-side policies in achieving potential output in the macroeconomy. It must be said that these things are used in conjunction, or at least should be considered with demand-side policies like monetary and fiscal policy. If you haven't learned about those yet, you certainly will soon, or if you have, you can certainly return to the earlier lectures of those two particular topics. Throughout this lecture, I have slides that just show you the IB objectives. I'm not going to go over them with you or read them to you, but that's to help you stay on track with what you're looking at. This is just the first of such examples. Supply-side policies are policies that appeal to improve the long-run aggregate supply of a country. To improve the long-run aggregate supply, if you remember, we see quantity or quality improvements in the factors of production. We can see that both in market-based policies and interventionist-based policies that would affect the long-run aggregate supply. In short, market-based policies, and I really like the quote, so I had to put it in there, seek to, quote, unleash the full power of the open market. What that means is we are restricting the role of government to allow the markets that will occur naturally to be as competitive as possible and to increase output and productivity by being competitive. Interventionist supply-side policies are those which the government intervenes to do things that would increase the quantity and quality of factors of production. Investments in education and infrastructure and things like that we will see. We can't get through a good economics lecture without a meme. So there's a meme and a dog and glasses and a suit. You can't not find cute. Again, IB objectives, we're going to take a look at market supply side policy first. And these policies are really drive to the heart of what Adam Smith believed made perfect competition good for an economy. But these market-based policies really creep up in response to the government spendings around the world in before and around World War II. So we start seeing these market-based supply-side policies, this neoclassical thought, creep in the 60s and 70s as a reaction to Keynesian economics. And these policies are adopted on a world scale by Margaret Thatcher of the UK and Ronald Reagan of the United States. And they become the face for these policies in the 1980s, then that are adapted and adopted also around the world. Market-based supply-side policies encourage competition, encourage labor market reforms, and encourage incentive-based policies to promote better competition and improve the long-run aggregate supply. Encouraging competition means deregulating, taking the rules off of firms in an industry so that they may operate more efficiently. Some of those rules actually do include anti-monopoly regulation, removing those so that firms may be as competitive as possible. Privatization, selling off government-run assets to the private marketplace so that the private firms might be more competitive, and promoting free trade. This is something that market-based supply-side economists, I think, sometimes forget, that free trade promotes free and fair trade, I should say, promotes competition worldwide. The second part of market-based policies that would improve the long-run aggregate demand is improving the labor market. And here you see some potentially very contentious ideas, depending on where you are, about reducing the power of unions, reducing unemployment benefits, and ending the minimum wage. If you remember from microeconomics, we saw that minimum wage creates an oversupply of labor. That itself is inefficient. Allowing the minimum wage for workers to fall back to an equilibrium level would be more productive for both firms and then in the long run for workers. Reducing those automatic stabilizers that we looked at with fiscal spending, those automatic stabilizers being like unemployment benefits, would encourage more efficient use of labor. And also reducing the power of unions. I don't know if you've much thought that what unions are designed to do, but unions promote labor even though labor might not be effective. So reducing the power of unions and unionized labor would make the labor market more efficient. Incentive-based policies are about reducing taxes, and reducing taxes for the income of individuals and for businesses should make the marketplace more efficient. Now, I will tell you up front that this is, first off, not an IB graph, but second off, it's from Wikipedia, so it is from a market. It is from a market um, bias from an economist who supports the market-based perspective, but it's economic theory that begets some investigation. It's called the Laffer curve, and the idea is that the tax rate doesn't always go. If the tax rate goes up, the government's revenue doesn't always go up, and if tax rate goes down, government revenue doesn't always go down. And the idea is that there's some happy midpoint between uh, 0 and 100%, at which the government revenue is actually maximized, and that if you reduce taxes to get to that point, you can actually increase government revenue. Or if you're below that point and you raise taxes, you can hit the highest point of that curve. The idea from many supply side economists is that we are way above, in the United States anyway, we are way above that tax rate point. So by reducing taxes, the labor market becomes more efficient and the government can make more money. Now, it says there in green, this is why the Bush tax cuts in the 2000s increased government revenue. You ought to be wise enough to know that all things don't happen in a vacuum. Other things are also going on that could increase government revenue at that time, but it's worth an argument here. And now again, you have a goofy little cartoon I found. Laffer was an aide to Ronald Reagan in the 80s, so that's where that comes from. If we are to evaluate these policies, we need to look at the pros and cons, advantages and disadvantages. For encouraging competition, you actually are going to have more consumer choice and more profit in the marketplace. More profit and businesses operating around profit can create corrupt firms who aren't interested in consumers but only are interested in profit. Labor market reforms will create labor that's more flexible, will create firms that can hire workers more productively, but getting rid of those labor market reforms could mean that workers lose rights, because as you ununionize labor, workers might lose the ability to fight for things that are best for them. And again, these things are arguable, but reducing labor reforms could actually create unsafe workplaces and products, or at least more unsafe than they are now. It doesn't mean that they're necessarily unsafe in comparison. Incentive-related policies will lower the taxes and will, in theory, produce higher yields from taxes. Again, perhaps if you go back to what our Laffer curve showed us, but those reduction in taxes might be disproportionate. It might affect the wealthy more than it affects the lower classes. It might put a bigger tax burden on the lower class. Now, to switch our gears and look at interventionist policy, interventionist supply-side policy seeks government investment in human capital, technology, infrastructure, and industrial policies, like promoting infant industries that otherwise might not get started on their own without government support. Take a look at this quick reading from a textbook that I've got, and you can see that government spending is fiscal spending, which would promote aggregate demand growth, but government spending also can promote long-run aggregate supply growth. You have to be pretty keen and a little bit more decisive when reading through sources that talk about fiscal spending or who talk about interventionist supply-side spending. It's probably affecting both the aggregate demand and the long-run aggregate supply curves, if you're careful of what you do or what you read. So we're not going to go into a long description of what these policies are, but we'll look at the evaluation. If you invest in human capital, in the training of people, training is universally accepted to improve worker productivity. The question is, how much training is necessary? And that's why you see that as a disadvantage. I'll give you two examples from the United States. One is with universal pre-kindergarten care. It's agreed that that would produce better trained workers in the long run, and also universal college education would produce better trained workers in the long run. The question is, as an economic tool, is it worth the investment? Will we get out as much as we put in to do that? We would have better trained workers, but at what cost? Investment in new technology. The government gets involved in supporting new research and development, especially in medical fields. That again is agreed upon to be very important for improving long-run aggregate supply. You see that with some of the military spending as well, and in the the 60s and 70s, the development of the early stages of the internet, all that's very important, but you see some of the disadvantages. I put wasted here in quotes. Critics of this say that money can get wasted and that it doesn't promote positive yield. Researchers and scientists would tell you that money is never really wasted, it's just not as productive as others. And all knowledge gained from scientific endeavors has a purpose, but economically, you can see why that wouldn't necessarily be too productive or too economically beneficial. And the last one is investments in infrastructure, bridges, highways, dams, global technology, things like that. Almost always have merit for society. Almost always do positive things for society. But again, the question comes up: who gets to bid out, or who gets these investments? Who gets these projects? Is it going to be firms who are the most competitive, or is it firms who are the most politically connected? If it's those who are most politically connected, then you lead to possible corruption. So, let's go back to the overall essential question here to evaluate the role of supply-side policies. Supply-side policies absolutely will work to achieve potential output. They are not necessarily all positive, as we saw that was the case with aggregate demand policies like fiscal policy and monetary policy, but used in conjunction and used with care, supply side policies can and will improve the long run aggregate supply of an economy. It can boost potential output of an economy. So there you have it. With fiscal monetary policies, supply side policy can be used to increase potential output of a country.